In the early months of 2010, the music that had fueled Greece's post-Eurozone borrowing spree abruptly stopped. The newly elected government shocked international markets by revealing that the nation's budget deficit was not the manageable fraction previously reported, but a staggering 15.7% of gross domestic product. Decades of deep-seated structural weaknesses, systemic tax evasion, and a reliance on cheap sovereign debt converged into a perfect financial storm. On April 23rd, from the remote Aegean island of Kastellorizo, Prime Minister George Papandreou formally requested an international bailout, signaling the onset of a crisis that would push the nation to the absolute brink of bankruptcy. To prevent a catastrophic default that could unravel the entire European single currency project, an international triumvirate composed of the European Commission, the European Central Bank, and the International Monetary Fund intervened. This alliance dictated a series of unrelenting austerity programs as a prerequisite for survival. Public sector salaries were slashed by up to 30%, the retirement age was abruptly raised, and value-added taxes were hiked repeatedly. The structural adjustment program succeeded in preventing an immediate financial collapse, but the domestic consequences were devastating. By 2013, the economy had contracted by a quarter of its total volume. Unemployment peaked at an unprecedented 28%, and a massive flight of intellectual capital began as 500,000 educated young Greeks emigrated in search of a future. The prolonged misery generated a powerful political backlash that reached a crescendo in 2015 with the election of an anti-austerity coalition led by Alexis Tsipras. The subsequent months devolved into a high-stakes game of brinkmanship with European creditors that paralyzed the Greek financial system. By June of that year, the government missed a critical payment to the International Monetary Fund and implemented strict capital controls, capping ATM withdrawals at just 60 euros per day to prevent a total run on the banks. With the prospect of an involuntary exit from the Eurozone looming, the government ultimately capitulated, signing a third macroeconomic adjustment program that guaranteed an additional 86 billion euros in loans in exchange for further sweeping structural overhauls. By the mid-2020s, the immense sacrifices of the preceding decade began to manifest as a remarkable macroeconomic turnaround. Greece officially concluded its formal bailout programs and achieved a remarkable fiscal transformation, consistently posting substantial primary budget surpluses. National economic growth rebounded to outpace the Eurozone average. Unemployment steadily dropped back into the single digits, and global rating agencies formally restored Greece's sovereign debt to investment-grade status. The financial plumbing of the state had been meticulously repaired, and international investors returned to a market that had once been deemed entirely toxic. Yet beneath the triumphant headlines of a recovered economy, the modern Greek state bears the permanent, heavy scars of its long depression. While the structural foundations are vastly more secure than they were before the collapse, the average citizen continues to navigate a profoundly altered reality. Real wages remain significantly below pre-crisis baselines. Inflation has continued to compress domestic purchasing power, and the losses incurred during the peak of the austerity years remain a vivid chapter in the living memory of a generation that watched its country serve as the grand, painful experiment of the European financial architecture.